presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello, everyone, and welcome to the Compak Asset Management Market Update for September the 6th, 2022. I'm Moe Ansari, President of Compak Asset Management and host of Market Wrap. I'm going to talk about the Fed. That's really the biggest thing that everyone is looking at right now. How much is the Fed going to raise interest rates? After the speech at Jackson Hole, everybody expects 60 to 70% probability that the Fed is going to raise interest rates by 0.75%. And that is causing the market to sell off a little bit because market was hoping, well, in June, they said, oh, that's it. The Fed is going to start lowering interest rates. That time you heard me say that I think that the market is getting overexcited, that we're going to get into August and September. We're going to get a pullback. That's where we are. But now we've gone from the Fed is going to lower interest rates to now the mantra is, oh, the Fed is going to kill the economy. I believe the Fed is not going to do that. They are going to raise interest rates, and a lot will depend on what happens to the inflation number on the 13th. Next week, we get an inflation number, and it's expected to be lower than 8.5%. If it is lower than 8.5, I think that would be very positive. If we get a number higher than 8.5, then the Fed will continue to raise rates. I'm going to talk about the market, the job analysis, technical analysis, and go from there. Again, market expectation. Market is looking at rates at around 4% is what we're looking at right now by the end of this year. So I think we are going to get there. They're going to raise by about 0.5%, so we'll see what happens. This is the starting point where we were. GDP growth expected, if it comes down to here, that's to bring down inflation. That's what the GDP is looking, jobs. We're here. We need to bring jobs down to this level. And that's the biggest thing. You've heard me talk about that quite a bit, where you've heard me say that unless we get the unemployment rate going up, this has been a recession for the one percenters. It's not a recession like we usually see. Usually we see the economy slowing down, people being laid off, and unemployment going up. This time we are seeing the jobs are still there. We've got more jobs than people, than job openings than labor force. So the recession has been in real estate, which has slowed down, and the stock market. So it's a recession for the one percenters. Unfortunately, those are the people that have stocks, that own assets, and it's been an asset recession rather than a jobs recession. We are going to get there sooner or later. I think the unemployment rate is going to start ticking higher, as we did see on the last report, but that was because we saw more people looking for jobs, not that people couldn't find them. Also, we are looking at the core inflation rate is here right now, expected to come down to about 2.5% that's where we need to have it. We're still somewhere around 5% right now, and that's where we are, the core rate. We needed 5.8%, it was the last reading. We need that coming down to about 2.5. We think it will, as gasoline prices have come way down, real estate is starting to come down. How much will that play through in rents? We'll have to wait and see. And food prices have come down. So all of the major ingredients of inflation are starting to come down. We'll have to wait and see. We need numbers for 2 or 3 months on a much sharper downward scale. Looking at the market, before the 12 months before elections, the midterm elections, the market does this. 12 months after the midterm election, the market does this. This is since 1930, going back nearly 80 some years or 90 some years that we're looking at, 92 years of history. I think, again, once we get past the midterm election, no matter who wins, it's always, oh my God, this party wins or that party wins. Doesn't matter who wins. This is what the market has done over the last 90 years. Again, if we see a shallow bear market, then we've had some great returns in the market following that shallow bear. That's what we've seen. If we see these shallow bear markets, we see the markets take off to the upside, and really the returns have been phenomenal after the shallow bear markets. Economy and jobs, again, we got a number of 315,000, a lot less than the 500,000 that we had, but still a very strong number. So we're still creating a tremendous amount of jobs in this economy. And as long as jobs are being created and we have more job openings than the labor, then I think with the recession, people will still continue to spend. And that's 2/3 of the US economy. Here on again, unemployment rate is starting to tiny little bit here. We saw it go from 3.5 to somewhere around, we saw a 3.7 number is what we saw. A 3.7 number is what we saw, 3.7 at the last report. And that 3.7% is still, I know it's higher than the 3.5 that we saw earlier on a month before, but again, 3.7 is very close to a 50-year low. This was the unemployment during COVID, comes straight down, and now we're again at very historical lows. Looking at where the unemployment rates are, the biggest drop has been in Alaska, Louisiana, Vermont. That's where percentage change in unemployment by state. That's where we're seeing some, and that was basically forward PE. A lot of people are talking about that. If you look at the forward PE, yes, it has come down. That's earnings per share. What we need EPS is earnings per share, and we're looking at still 9% in the US. I don't know if you get 9%. I think if you get 5 to 6% earnings per share growth next year, that will be good. We'll have to wait and see where we go. But as long as earnings are positive, companies are still making money. And the more money a company makes, the more valuable their stock is. It is that simple. Don't forget to tune in to my daily broadcast every single day. You can go to Market Wrap with Moe, and one word, type all of that in your search at the Apple Store, and you can get my app. It is absolutely free. And then you can get the daily edition of Market Wrap, where I talk about the markets, great guests every day for 1 hour. You can do that. Looking at the technicals, interest rates, again, going closer to 3.5. We're at 3.34 today. 3.5 is the previous high that we made right here. I think we could go and test it or break it slightly, and then we'll see where we go from there. Last time we hit 3.5, we came all the way back down to nearly 2.5 or 2.6. So we dropped 1% right here. Since then, we've gone right back up in rates. Again, if we get up here and we see inflation coming down, that could bring rates down. Rates is what will the Fed do? That is the biggest thing that the S&P is going to do. S&P, I thought would hold around the 50-day moving average. I expected when we hit the 200-day right here, from there to see a decline. I did, but it's gone a lot farther than I was looking at right now. So we have gone below the 50-day moving average. Next support is a tiny gap right here, which gets filled at about 3,800, 37.96. So that's going to be support. If we break 3,800, then probably we're headed to new lows, at least the test of the 36.36, and maybe even break it slightly. That's what could happen in the markets if we break 3,800. That will depend, again, how the inflation number comes out next week. If it comes out lower than 8%, it gives the market some hope that the Fed might take the pressure off the brake a little bit. It might only go 50 basis points instead of 75. On a weekly basis, we saw the S&P get, again, very close to the 50-week moving average. We've come down from there. Again, this looks more like an ABC correction. That's what it is. After a fifth wave, we get a market down move, which we've seen since the beginning of this year. Now we've got a little bit of bounce, but was this wave one, wave two, and are we starting wave three? We don't know that. It depends on how bad the recession is going to be. I still feel we're going to get a mild recession, but if it's a deep recession, all bets are off, and we could probably go quite a bit lower. NASDAQ, very similar picture. We have a tiny gap right here, which is around 11,275. We closed at 11,554, 545 today. 11,275 is the number that I'm looking at. If that gets filled right here, this number right here, and probably we're headed to these lows right here and these lows right here. And that would also put us in jeopardy of turning my dot plot down, which is somewhere around 11,000. We come down, that's also the 200-week moving average. Came and tested it last June, bounced off of it. My dot plot turned up, the market went above the dots, which is good, and it is still above the dots, but 11,000 turns down, and I just don't like the way this market is looking. We're at 545 today, so another 500 points lower, and the dot plot turns negative, which is very seldom that we only see 4 or 5 weeks of the market going up and coming right back down. Usually when the dot plot turns up, it usually stays positive for a year to 2 years. That's what usually it stays positive. So turning down this quickly would not be a good sign, but we'll see. Next week or so should give us that. Oil prices, again, OPEC said they're going to reduce production by about 100,000 barrels. Doesn't mean much. They can't even meet the quotas now. I think it's more of a political statement from Saudi Arabia telling us, hey, don't make a deal with Iran or we'll cut back oil prices, and oil prices could push gasoline back up. Again, support 85.73, right around here. This low right here. Well, last 3 days, we've come down to about 86. That was a low today. And then resistance is the 50-day around 97. As I've said, 85 to about 105 is where we stay in oil. Gold looks terrible right now. We're starting to see the gold market come down. It's starting to break to the downside. 1,700 is support, and this low right here is 1,678. That was the low that we made in July. A break below that, and 1,600 becomes a target, plus or minus, for the gold market. So as you know, I've not been very positive gold. Right now is the time to be cautious in these markets, depending on what things look like after the inflation number next week. And if that comes out stronger and the Fed raises by 3/4 point of a point, I think we have a little bit more on the downside. That's why you have to keep your balanced portfolio. Make sure you have some cash available. Pick off the companies that you like. If they come down to prices that you really want, particular company, then you should add that to your portfolio. Looking at I think we're back at the 50% level, chance of a recession. But again, is it a deep recession or mild recession? That's really going to be the case. I'm going to do a webinar, yes, I am, on November the 2nd. Yep, that's a couple of months away. So if you want to register, you can go to register@compak.com for seminars, click on that, and you can register for free. It's about a 2-hour update, but we're still a couple of months away. Look ahead, again, looking ahead, it's going to be that inflation number that's going to really drive the market next week. Those are my thoughts. Those are my observations. I will be back with you at the same time next week. Until then, good trading.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.